Hello, and welcome to the ConstructorCast, your AGC place for all the news, views, and interviews relevant to your construction business. I am your host, Leah Pilkonis. This is the 9th recording in our COVID-19 special edition series, where we bring you timely information on factors that construction companies need to consider as they strive for business continuity in these challenging and unprecedented times. On Friday, June 5th, the president signed into law the Paycheck Protection Program Flexibility Act of 2020. That measure makes significant improvements to the program that will allow businesses more flexibility in using their loan funds. My colleague, Matt Turkstra, who is the head of tax, fiscal affairs, and accounting with congressional relations for AGC of America, and Matt has been a regular on this COVID-19 special edition series, is here with us today to walk us through some big changes. AGC has been pushing for the passage of this bill, and AGC has recommended many of the fixes that Matt is going to walk us through today and explain to you. And these fixes are really designed to help construction firms survive. So this marks a big legislative victory for AGC. Matt, I want to ask you to start off with giving us some background about this bill. And can you just share with us, how did it come into being and what was the process for all of that?
Thanks, Leah. It's actually, it's kind of an interesting story. So when the Paycheck Protection Program was created after the passage of the CARES Act, there was a huge surge of demand for the program at the SBA. The borrowers demand clearly outstripped supply, and the SBA at one point was clearing just a tremendous amount of loans per day, in the billions and billions of dollars per day. And of the original $349 billion that was allocated to the program, that was exhausted fairly quickly. And it required the passage of a second piece of legislation to plus up that program, refill the lending authority for the SBA. As the program went on, though, some additional rules and regulations came out of SBA that had the effect of really reducing demand and scaring off some borrowers. And indeed, we actually heard from some AGC members that had actually returned their loan funds out of fear of being audited or False Claims Act lawsuits and so on. And what that really cried out for was some fixes to the underlying statute to really clarify that Congress intended for these funds to be flexible, to provide resources to companies so that they could retain as many employees as possible. And there was actually a freshman member of Congress named Dean Phillips who worked with a Republican member as well, a member named Chip Roy from Texas. And the two of them worked together and actually introduced this legislation. Congressman Phillips, who's a Democrat, negotiated with the Speaker, Nancy Pelosi, to try to get this legislation on the floor as a result of his, or as contingent upon his support for the Democratic stimulus legislation, the HEROES Act. And then it just came together very, very quickly. We were very fortunate to have some strong advocates for these provisions, and it really came together over about a 2-week period with a lot of input from the stakeholder community, including AGC. But we were just absolutely thrilled with some of these changes. Now, I want to caution people, it doesn't solve all the problems with the program, and we'll go through some of the details in a moment, but it really does make some pretty substantial changes that I think will have a material benefit to people, and also hopefully reduce some of the fear that some people had previously had, and hopefully spur some additional demand to the program, because it's really stalled out over the past 3-4 weeks or so.
And there are still funds left then in the program.
There are, yeah. It's I looked at the numbers a few days ago. I think it's about $100 billion, a little bit over $100 billion. But what's interesting is the amount of loans that are available has actually increased over the past couple of weeks because folks have been returning the money. So it's actually going in the wrong direction. And we're hopeful that these changes will lead to some increased demand in the program as folks reevaluate whether they want to borrow this money.
Okay, so these changes are much welcomed and hopefully going to lead to some better success for the program overall.
Yeah.
So let's get into some specifics. So I know a draw to the program has been what we had hoped and what I think will be now with the Flexibility Act, the ability for borrowers to have the loans forgiven or essentially converted into tax-free grants. But previously, there were a lot of conditions and limitations. So first, Matt, can you talk us through the recent changes with the Flexibility Act regarding how borrowers can spend the funds and how long they can take to spend the funds to still qualify for loan forgiveness?
When the CARES Act was written and the structure of the program was really set, I think Congress was acting under a set of assumptions that, the economy would start to be reopening, probably at the end of June at the latest. And as a result, they kind of wrote the legislation and the parameters around the loan program with that in mind. And as the shutdown has dragged on, as the pandemic has dragged on, and as the economic slowdown has dragged on, I think there's been a general agreement amongst virtually everybody involved that this has gone on longer than originally anticipated. And when the program was originally set up, like I said, with the assumption that the economy would open the end of June, that was actually part of the loan program as well, and that you had to actually you had to rehire all of your workers and expend your loan funds by the end of June before you started applying for forgiveness. So what this, and in many cases, that's, we're seeing locations that are still largely shut down and establishments that are shut down. So what they did is they extended the amount of time from 8 weeks when you receive your loan funds that you need to use that loan funds for payroll and non-payroll purposes, 8 weeks up to 24 weeks. So originally it was a 2-month. You had to use all the loan funds within a 2-month window, and then it extended. The legislation extended it to 24 weeks. Additionally, there was a regulation that was put into place. It didn't actually exist in statute, but a regulation that Treasury said that 75% of the funds needed to be used for payroll costs and 25% could be used for non-payroll costs. And those were things like mortgage interest, rent, utilities, and the like. And many businesses found that to be too restrictive. And even though it's called the Paycheck Protection Program, that we want, I think, the people who wrote the legislation wanted to make sure that there was a business still standing there for people to be employed by when they go back to work. So they reduced that ratio slightly from 75% for payroll costs and 25% to non-payroll costs to 60% for payroll costs and 40% for non-payroll costs, respectively. This was particularly problematic for businesses in large cities where things like rent and utility payments were quite high. Hopefully have a boon, not just for construction workers and providing them with some additional flexibility, but also preventing the loss of business and investment for companies that will hopefully in the future be taking on some construction projects themselves.
Two very meaningful changes: longer coverage period and revising the ratio of expenses allowed to be forgiven. So you explained that very clearly. Thank you. Another change. So AGC, I know, was very concerned about the ability of companies to rehire employees or return to the same level of business activity as pre-COVID-19, and just how this would affect the employer's loan forgiveness amounts. How has that changed with the new amendments? Is there more flexibility there?
Yes, especially since the passage of the CARES Act, and one of the additional things, aside from the creation of the PPP program that the CARES Act did, is that it provided enhanced unemployment benefits including a $600 bonus payment per week for recipients of unemployment insurance or unemployment benefits. And in a lot of cases, we've heard anecdotally, at least, that trying to get people to return to work can be challenging when unemployment benefits are as generous as they are. And I wouldn't say this applies strictly to construction, but across all industries. So as a result, one of the changes that they made in the program was that if you were an employer, but you had made a good faith effort to try to rehire qualified employees back to your business, that would count as meeting the necessary threshold. One of the requirements for PPP is that you need to have payroll and an employee headcount that's roughly equivalent to what you had pre-pandemic. And many people just weren't able to meet that requirement due to folks that were just not able to find workers, either through the unemployment benefits or for totally natural reasons, folks not wanting to come back to work for whatever reason. So this creates some additional flexibility in that if you make a good faith effort to hire people back, but you can't find qualified employees, you have a safe harbor now in the loan forgiveness.
Safe harbor if you make a good faith effort to hire or rehire qualified employees. Okay. What about PPP loans with any unforgiven amounts? I understand there were some changes there.
Even if when the program was set up, even if you didn't entirely have all of the loan forgiven, the terms of the loan were actually quite generous. It was a 1% interest rate, and that you had to pay back over 2 years, which is for some folks is a good deal, and irrespective of whether or not you apply for loan forgiveness or not. What this change did is it actually made it even more generous by extending the maturity, length of maturity of the loans from 2 years to 5 years. So if you have any outstanding balance from a PPP loan that is not forgiven, you have up until 5 years to pay it back. So that's a nice change as well.
Okay, great. So revising the maturity period for the loans. I have one final question. How does the new forgiveness amendment change things for borrowers regarding the employer's ability to delay its share of 2020 payroll taxes?
Yeah, that's a really good question, Leah. The CARES Act set up a number of importantly, the Paycheck Protection Program, but also a number of tax provisions. And the general rule to follow with those tax provisions was that if you were going to be receiving a benefit from one, you couldn't be perceived to be "quote unquote" double dipping and claiming a benefit for the other. Well, I think that's certainly true for some of the programs that basically provide incentives or tax relief, or in the case of the PPP loans, direct funding for doing roughly the same thing. Like, for example, there's a program called the Employee Retention Tax Credit, which provides a up to $5,000 tax credit for employers to keep people on their payroll throughout the pandemic. Well, it makes sense that you would want to not provide people that tax break and also give them a PPP loan that's forgiven for roughly the same thing. So it was a fairly good standard to set up. But one thing that they did is that they barred recipients of PPP loans from taking advantage of another provision in the CARES Act, which was to defer your payroll taxes through the end of 2020. So this is an incentive that was put in where if you were you can defer your payroll taxes, but the catch is that you do have to pay them back, but it's just over a 2-year period. And it didn't make this isn't a grant. It's not a tax cut or a tax credit or anything. It's just a delay in the payment. So wisely, I think they made the change here as well, that if you are a PPP loan recipient, you could also take advantage of this delay in deferring your payroll taxes through the end of the year. So that's another positive change that'll hopefully help people with their cash flow as they're managing their business through the crisis, and hopefully be another reason to spur some additional demand for the program.
Great. Yes, absolutely. Well, thank you so much, Matt. We're very lucky to have you to explain all of this to us in simple and easy to understand terms. Is there anything that we missed that you want to share?
The one thing I will add is that, as I said earlier, this is not the last word on the Paycheck Protection Program.
Of course not.
Unfortunately, there are a few outstanding issues remaining that do need to be addressed. There's some clarifying language because the bill, as I said earlier, came together very quickly, as is often the case with bills that are kind of rushed through. There's probably a correction or two, or just a clarification or two that may need to be made in subsequent legislation, as well as another largely outstanding or a very important outstanding issue is that the IRS made a ruling recently that actually it's not so recently anymore, it was almost 2 months ago, that if you received loan funds and those funds were forgiven through the Paycheck Protection Program, that you wouldn't be able to deduct the expenses associated with that forgiveness income. This was kind of a backhanded way of basically making the forgiveness funds taxable when they were explicitly supposed to be non-taxable in the underlying statute. So that was not addressed in this legislation, and it will need to be addressed subsequently. The good news is that there's a lot of support for it amongst both the Democratic and Republican heads of the tax writing committees, and both in the House and the Senate. So we're hopeful that this will get addressed in subsequent legislation. So I think, as I said, it's not the last word on this. We're hopeful for some additional changes, but we're continuing to push on that, and hopefully we'll see some resolution shortly.
Okay. All right. Well, I mean, great work overall. Very positive steps have been achieved, and stay tuned for more information. I do want to remind everyone to visit AGC's coronavirus webpage for the latest news and information, and that's at www.agc.org/coronavirus. This has been another episode of AGC ConstructorCast. Please subscribe to ConstructorCast from your podcast app, or stream all available episodes right from your computer at www.agc.org/ConstructorCast. Thanks for listening, and stay safe and healthy, everyone.